Hi everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, January 31st, 2026. Hey, I hope you're doing well. I hope you had a good week last week, trading week, and everything in your week was an interesting week last week. You know, the markets were quite volatile, so I hope you stayed safe through that, and I really appreciate you being here for my weekend review. I really hope that you are going to find it helpful and find something of value. So I'll let you know the format of the podcast today. First of all, we were going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades that I made last week. We're going to look at all the positions that I'm still in and managing. We're going to look at the positions that I exited. So we're going to talk about when I entered the trade, why I entered the trade, what the confluences, what the signals were, and then how I am going to manage the trade going forward. So hopefully this will give you an idea of how I trade, how I look for entries, why I exit, and how I manage things while I'm still in the trade. The biggest thing always being I try to be very, very impatient with my losers. If things aren't working, I get out quickly, and then I try to be very patient with the winning trades that I have. And, you know, I have a process that does that for me, that keeps me in good trades as long as they're good trades to a certain point. And then I have a process that gets me out of trades quickly when I'm wrong. So after that, we're going to talk a little bit about trader psychology. Most important skill in trading is the ability to create a plan and to follow it. So I always like to touch on that every week. It's always helpful for me to teach it, and so I hopefully it's going to be helpful for you to hear as well. After that, I do go down through my master watch list every Friday night, one by one, and I look for potential setups for the upcoming week. Now, what I've highlighted to show you today, they are not where they need to be yet, but they're within striking distance. They're getting close. And what I'm looking for is major levels of support, order blocks, moving averages, RSI levels, ideally all of these together. And then I look at these, mark them down. I know where those levels are. And then I look next week to see if we get to those levels and reject those levels. And if we reject those levels, then I'll consider taking a trade. And, you know, generally always I will have a very good risk to reward ratio. So if it rejects a level, okay, I consider taking the trade. I take the trade. If I'm wrong, getting out quickly. If I'm right, again, back to having the process that keeps you in it. So it looks like I have 11 potentials for this coming week. So I'll go through each one. I'll explain what I'm looking for, and I hope that's going to be helpful for you. So like I said, it was a volatile week, especially with the metals on Friday. And so I hope that you stayed safe there. I hope you are being patient and taking the trades that you should take and getting out quickly if you're wrong. So let's run this U.S. legal disclaimer, get that out of the way, and then we'll get rolling. So hang tight. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, thanks for holding through with me, and let's get started on the current open positions that I have. So I trade 7 different strategies. And so as I go through each particular trade, I'll explain what the strategy was. The best trades that I have are the strategies that overlap each other, so they're a combination of both. And this is one of them. This is Coca-Cola. This has been a great trade. I entered Coca-Cola here on the 7th of January at 67.53, and you can see it's gone straight up. So great, but Greg, why did you take the trade? So 2 things here. This is a combination of a deep dip buy along with an order block. So let's first talk about the order block and what an order block is. So the order block formed here on the 3rd of November, and let me explain to you why that is. So for an order block, the way that I trade order blocks, people trade order blocks many different ways. They really do. But um, the way I try to make things easy for myself and then also for my students in the way that I teach order blocks. And so this is what I consider an order block, and it works very well for me. So the first thing I'm looking for, I need to have a swing low. A swing low is a low that has a higher low to the left and a higher low to the right. See how we have a higher low to the left and a higher low to the right? Makes it a swing low, right? After the swing low, I need a swing high. Now, a swing high is just the opposite. It has a lower high to the left and a lower high to the right. So I have a swing low, and then I have a swing high. And then after I have the swing low and the swing high, I need to have another swing low, which is right here, that's lower than the first swing low. Okay, so swing low, swing high, another swing low that's lower than the first swing low. What's important is that we run the liquidity on that first swing high, or in other words, we go down and take that swing low out. So swing low, swing high, we ran the liquidity, we went down from the first swing low, and then we created another swing low that was higher than the first swing low. So swing low, swing high, swing low. Okay, as soon as this happens, now you have to reference back to your first swing high, which was right here. Swing low, swing high, swing low. Now at this point, there's nothing to do until here. This is where on this bar, we took out this swing high. And what this does is it changes the market structure to the upside. So here it is again. We need a swing low, followed by a swing high, followed by a lower swing low than the first one, and then we need to take out that first swing high, or in other words, go above that swing high. As soon as that happens, now the lowest closing bar prior to the market structure change is your order block. And so my order block is the high and the low of this bar on the 3rd of November. So that is why I've highlighted the high and the low of this bar and taken it into the future. So before we get to the entry, we change market structure here, and then we continue to go higher. So look at the prices up here. So when you look at the prices here, and now you look back to the order block that was formed, is it fair to say that smart money was buying this here? And I would say absolutely, clearly, because the market is so much higher. So the people that were buying here, they did very well. So I would consider that smart money after the fact where the market has gone up. So the idea here is that now we know that smart money was buying here. So I am waiting now for prices to come back to the smart money area. Now, because it was smart money here, which clearly in hindsight, it was smart money here when it moved all the way up here, does it mean in the future if it comes back down to that, it's still smart money? And the answer is no, and not 100% of the time. Like things can change, right? But in my experience, and I've been trading for over 30 years, more times than not, when the prices get back to that original smart money area, they're smart money again. So again, let's look. Swing low, swing high, lower swing low, market structure change. As soon as the market structure changes, the lowest closing bar prior to the market structure change going forward was the smart money area. So now I'm looking for a pullback to that smart money area. Okay, so clearly we came back into the smart money area, and I entered here right at the low. Why did I enter here? Well, this is where the deep dip buy strategy comes into effect. And if you look at the day that I entered the trade, take a look at the RSI. The RSI is 3107, but we did not close at the low of the day. So during the day, that RSI was lower, and it was lower. It was under the 30 RSI at one point during the day, but yet it closed back above it. That is called an intraday rejection of the 30 RSI. Now that by itself is a legitimate deep dip by entry signal, but it happened inside the bullish order block. So that's the confluence of the signal. We had a rejection of a 30 RSI, which is a primary signal, inside a primary signal area, which is the deep dip buy area. So that is why I took the trade. In addition to that, we also rejected the negative third ATR channel. You can see this kind of thicker green line is the negative third ATR channel. Up here is the positive third ATR channel. And generally, when you get to the positive third ATR channel, you go down. When you get to the negative third ATR channel, more times than not, you go sideways or you go up. So this is also a key level, just a general level. I don't take a trade just based upon this. It has to be a legitimate primary signal as well, but we had the primary signals. We had the under 30, over 30 inside the bullish order block, and cherry on top, it rejected the negative third ATR channel. So look, this is a great trade. I didn't know it was going to do this, right? But you never know. All that I know is I had an under 30, over 30 inside a bullish order block, so I entered. Now, well, let's talk about the position sizing and then I'll talk about the stop. So anyway, that's why I entered under 30, over 30 in the order block at 67.53. So as soon as I enter, the first thing I need to decide, obviously, is how many shares I'm going to buy. And this is the formula that I use. It's worked very, very well for me, and it's very simple. I simply take 1% of my account, whatever my account value is. Let's say it's $100,000. 1% of $100,000 is $1,000. I simply take that 1% of my capital, divide it by the value of the 2 ATR. The value of the 2 ATR right now is 225. So I take 1,000 divided by 225 would tell me to buy 444.44 shares. So I would just round it down to 444 shares. And so the effect that this 2 ATR has is that it is measuring the volatility. As volatility increases, its number gets larger. As volatility contracts, its number gets smaller. And so when volatility increases, it has the effect of reducing the amount of shares that I have, which is correct trading. When volatility is higher, you need to increase, when volatility is higher, you need to decrease the amount of shares that you are entering, okay? And so here we go. Rejection of the negative rejection of the 30 RSI inside the order block, okay? First thing, like I just showed you, how to position size about 444 shares here. Now, the very first step after I enter the trade is I need to look to the 2 ATR, 2.25 at this point, or whatever the ATR is at the moment that I enter the trade. I take my entry price minus the 225 and I put a red line below here. This is my emergency stop. This is exactly 2 ATRs below the entry of my trade. Now, we just did the math, right? We took $1,000 divided by 225. So if in the future this does get down to my emergency stop, we already did the math, and how much would I lose? I'd lose $1,000, right? If 444 shares moves 2.25, I lose $1,000, or in other words, I lose 1% of my account. Not fun, but you can recover from this, okay? But the good news is that I only hit the emergency stop about 5% of the time, although 2 weeks ago I hit 2 of them, and this week I hit 1 of them. So they do happen, but they only happen about 5% of the time. The other 95% of the time, if I have a loss on the trade, it is not going to be my emergency stop. It will be my end of bar stop. And remember, on this particular trade, why did I take the trade? I took the trade because we went under 30 and then closed back over 30. So therefore, on this strategy, If the next day it had closed back under 30, or in other words, it negated the reason why I took the trade in the first place, I would simply get out, and very likely for a much smaller loss. I mean, I have the safety net of the 2 ATR, the emergency stop below, but the majority of time, if I have a loss, and I have lots of losses, they're going to be much smaller than the emergency loss, because the stop loss line in the sand for me is much closer to my entry price than the emergency stop. Okay, so again, rejection of the 30 RSI inside the order block, take the trade, position size, like as I discussed, I place the emergency stop 2 ATRs below. My end of bar stop is simply a close below the 30 RSI. Now, the next thing I do, as soon as I enter the trade, I look and I know where my emergency stop is and my end of bar stop. I look to the value of the 1.5 ATR. And whatever that value is, I add it to my entry price, or in other words, I put it above my entry price. And this is the orange line right here. And so if I enter the trade and it does move up to my trailing stop level, I don't have to take any action. It's just that if it does move 1.5 ATRs from my entry and I get into trailing stop mode, all this means now is in the future, if I have a close below a previous bar's low, I'm going to exit half of the position. And in trading, when you take a trade and it starts to move your way by a certain amount, for me it's 1.5 ATRs, then if the trade starts reacting negatively, I want to take some action and take something off. And this has the effect of tightening up your stops, right? If you have a trade and it goes way up, you've heard, right? You want to tighten up your stop because you don't want to give all that back. So that's exactly why I do this. So until it gets to the emergent or to the trailing stop level, I don't need to do anything. But once it gets there, I still don't do anything. It just means that now in the future, if I have a close below a previous bar's low, I'm going to sell half. And selling half has the effect of tightening up your stop by half. It's like moving everything up by half. So you're really tightening it up, right? By taking half off. So that's why I do this. So, and I'll put this trade together completely after I just go through each component. All right. So we've talked about why I took the trade. We've talked about position sizing. We've talked about the emergency stop. We've talked about going to trailing stop mode. These are all defensive maneuvers. Or in other words, if the price goes against me, this is a long trade. So if it does something where it goes down, I have to take some action. Those are defensive moves. But I don't just like to play defense in my trading. I also like to add an offensive component to it as well. And the way that I do that is I take a partial position off each day if the price moves a certain amount from the closing price of the current day. So let me show you exactly what I mean for Monday. All I do is I take the closing price of the day. Right now, Coca-Cola is 74.81. And I simply look for the value of the 0.45 ATR. The value of the 0.45 ATR is 51 cents. So this is for Monday only. I take the closing price, 74.81, plus 51 cents. My first profit target for Monday is 75.32. If it does get to 75.32 at any point during the day, I will take 10% of however many shares I went into the day with. If I go into the day with 400 shares, okay, I would take 40 shares off at that first profit target, 75.32. Okay, but I always place 3 profit targets. So the first profit target was 74.81, the closing price, plus 51 cents, 75.32. I would place a limit order for the day there, and if it does hit there, however many shares I went into the day with, I would take 10% off there. Now I place a second profit target, and the way that I find that is I just take the first profit target and again add the value of the 0.45 to it. So plus 51 cents. My second profit target for Monday is 75.83. And again, how many shares do I take off? 10% of what I went into the day with. If I went into the day with 400, I would take 40 off at the first, 40 off at the second, and then I do one more. I take the second profit target, 75.83 plus 51 cents. And if it got to 76.34, I would hit another profit target and I would take another 40 shares off. So I've been using this for many, many years. And, you know, it has so many advantages. One, you want to play defense, you want to play offense, but as every profit target that you hit has the effect of reducing your overall risk, reducing your position size, and just by default, tightening up your stop more and more as you go. And the fewer and fewer shares you start having, the more likely you are to continue with following your process. So it just makes sense. You know, in sports, you want to play offense and you want to play defense. And trading is a sport, so I want to play offense and defense. So I'm a huge fan of taking partial profits. So, all right. Now that we know, and I've kind of given you the components, let's one more time just kind of look at the basics of this trade. Entered here on the 7th of January at 67.53. Why? Rejection of the 30 RSI inside an order block. I took the trade. I position size. I placed my emergency stop 2 ATRs below. My end of bar stop is a close below the 30 RSI. I placed my trailing stop level 1.5 ATRs above, and away we go. The next day, huge day up, right? I hit multiple profit targets. I took multiple top profit targets off into that strength, and we also got to trailing stop mode. Perfect. Don't do anything. It's just that now I'm in trailing stop mode. The next day, another huge day up where I hit multiple profit targets. Fantastic. Next day, really didn't do much. No action taking. The next day goes up again, another profit target. Next day goes up a little. I can't remember if I hit a profit target. And then here on the 15th, we had our first close below a previous bar's low. After reaching trailing stop level, what do? I take off half of the remaining shares that I have on that day. And what's the effect of that? Well, it moves all my stops way up because I've just reduced my position size by half, okay? But I don't sell all, I sell half. And next day really doesn't do anything. The next day starts off bearish, but ends up very bullish, right? Oh, by the way, I took off half for a gain of 4.14%, okay? Next day goes up, profit target. Next day, nothing. Next day, nothing. Next day, up again, profit target. Here on the 27th, profit target. And you can see on Friday, big day up, multiple profit targets. Now, when I get around the 65 RSI level or I get to the 70 RSI level, I have additional rules on how to exit the trade completely. Right now, we are at 70.79. Okay. If we reject the 70 RSI, or in other words, if we in the future close below the 70 RSI, that will be another signal for me to take off half of the remaining shares that I have. Remember, going into trailing stop mode and having a close below previous bar's low, I take off half, right? But now that we're getting into this overbought level, if we reject the 70 RSI, I will sell half of just what I have remaining, okay? Then at that point, if we have a close below a previous bar's low, I will get completely out of the trade. Additionally, if I get to a 65 RSI level and then close below this 5 EMA, I'm also going to be out. So I have lots of rules for sure, but you know, we're in the area where you could expect a pullback. And so therefore I'm instituting rules that I have now to reduce my position size. But as long as this stays above the 70 RSI, I'll stick with it, continue to sell into the strength. So this has been a really, really, really good trade. And the remaining shares that I have on Coca-Cola at the moment are up 9.76%. And again, it all started with just an under 30, over 30 inside an order block. If I was wrong, I had the potential to be wrong very, very small because my risk to reward ratio was very good going into the trade. So really great trade. Remaining shares up 9.76%. TLT. Okay, TLT is a trade called an abandoned baby, and let us go back to why I took this trade. Now, this trade is underwater. This is a little different trade than I usually take, but let me highlight this bar here on the 23rd of December. I highlighted it green. Why? Well, because the previous day we gapped down. You can see the previous day we closed here, then we gapped down. Very bearish, very bearish, very bearish sentiment. However, the very next day we immediately gap up. And here's the key. When you have a sudden change from bearish to bullish from day to day, boom, gap down bearish, gap up bullish. When you have a sudden change in sentiment like this, it generally indicates higher prices. Doesn't happen all the time, but more times than not, it does. And so the day that I took the trade, we came back, we rejected the high of that abandoned baby. I entered at 87.73. So on this particular trade, I don't take partial profits. This is the only strategy where I manage it a little bit differently. And the way that I manage it is I place a 2 ATR emergency stop below, like I do on every single trade. And again, if it got there, how much would I lose? 1% of my account. But on the upside, I place a 4 ATR profit target above. Or in other words, I'm risking 2 ATRs to make 4 ATRs. So if I'm right, I'm going to make twice as much as if I'm wrong. And in my experience, abandoned babies go up, go the direction I want more than they go down. So that's pretty good. If they go in a direction that they're more likely to go, I make twice as much as if I'm wrong and I lose 2 ATRs. So I entered here 87.73. I place a 2 ATR stop. I place a 4 ATR profit target, and I just let this trade go. That's it. Eventually, for sure, you can see here on the 20th, we almost got down there, almost touched it, in which case I would have had to get out, but it did hold, and then it rallied, and then it came back, right? So I am underwater on this trade at the moment. Not too bad, 0.7%. But I'm just going to let this go, and eventually it will hit my 2 ATR stop, or I will hit my 4 ATR profit target. But the whole key about this and taking this bullish abandoned baby is, in my experience, more times than not, I will make 4 ATRs than I will lose 2 ATRs. And that's pretty good math. Let me show you an example. So this is down 0.7%. I do want to show you a trade. I marked it down. I forgot to share it with you the entry last week, but this is from one of my students that shared this trade with me, and this is an abandoned baby. This one here in the green, right? We gapped down, bearish, and then we gapped up, okay? Now, he waited for the rejection of the high of the baby, see right here. So we gapped down, gap up, came back, tested the high of the abandoned baby at 57.96. He placed a 2 ATR stop below, and he placed a 4 ATR profit target above. So if he's wrong, he's going to lose 1% of his account. If he is right, he is going to make 2% to the upside. So he has a good risk to reward ratio. He has asymmetrical risk. So meaning if he's wrong, he's going to lose less than he's right. And if he's wrong, he's going to lose less than if he's right. And if he's right, he's going to make twice as much as if he were wrong. So it's very simple. Created the band of baby, position size, 2 ATR stop below, 4 ATR profit target above. Kind of a set it and forget it trade. One of these things are going to happen. And then for 4 days, didn't really do much. Then we had a big up bar, but see how it did not get to his profit target yet. And then look what happened the next day. It gapped above his profit target. So he actually made more than 2% on the account. And this got him out of the trade. So this is a perfect example of an abandoned baby with 2 ATR profit target and a 2 ATR stop and a 4 ATR profit target. So congratulations, that was just a great trade, and it started with the abandoned baby, and it kind of did what it does more often than it not. It goes in the direction that the abandoned baby showed. So really great trade. Congratulations. Okay. So let's go on to the next open trade. This is T-Mobile. So I entered T-Mobile here on the 28th of January at $186.20. So why did I enter this trade? Well, this trade had to do with a long-term megaphone trend line. So a long-term megaphone trend line, what you want to do is I take a swing low and then I look in the future for a lower swing low and I connect the trend line between the two. I connect this bottom to this bottom, and then the trend line is going to continue to go out into the future. Generally, when you do this, when you have a swing low followed by a lower swing low, the third time, this is the first, this is the second, the third time you get to that trend line, if it reacts to the trend line, reacts meaning it goes below it and closes back above it, it's generally a good time to enter the trade. And I did this here on the 28th. You can see the previous bar closed below, and then the day I entered, it closed above. Okay, and I entered here at 186.20. Now, did I take it just because it closed back over this trend line? No, I didn't take it just for that reason. That's one of the reasons. But we just talked about abandoned babies, and look what happened. On this day, from this day to this day, we gapped down. This day that I took the trade, we gapped up. So what does that give us? That gives us a bullish abandoned baby. A gap down followed by a gap up, in my experience, is very bullish. And that also dovetails with the close back above the long-term megaphone trend line. And so that is why I entered the trade at 186.20. So I position sized, I entered the trade 186.20. I placed my emergency stop, as always, 2 ATRs below. My end of bar stop on this trade would simply have been a close below the trend line. See how close I am to the trend line anyway? So the very next day, this had just closed below, I'm out. It's done, right? Small loss, I'm done. But thankfully it held. So I entered here, 186.20. After I know where my emergency stop is, my end of bar stop, I place my 1.5 ATR trailing stop level above, right? Next day, takes off. I hit a profit target. Fantastic. And then on Friday, big day up. I hit 3 profit targets on this day. So I sold into that strength. So clearly I'm in trailing stop mode. I took off 30% of the trade into that strength. So it's a good position. So now going forward, if I have a close below a previous bar's low, I'll simply exit half. If we get up into the 65 RSI level, 70 RSI level, then those are the levels that I'll be looking to exit the trade. So this particular trade doing quite well in 2 days, up 5.61%. And again, it was a combination of a bullish abandoned baby and a rejection of a long-term megaphone trend line. And it worked out just great. So I'm very grateful for that. McDonald's. Okay. I entered McDonald's here on the 21st of January at 305.20. Why? Well, look, we have an order block. On this particular day, we rejected 2 important parts of the order block. The first is we rejected the high of the order block. You can see the previous day we closed in the order block. The next day we closed above the order block. A rejection of the high of the order block by itself is a legitimate primary signal. But I always like confluences, right? Well, the confluence was this black line. This is the 200-day moving average. This 200-day moving average lives inside the order block. So let's see what happened. The previous day we were in the order block. The next day that I took the trade, it closed above the order block, and it also closed above the 200-day moving average. There's your confluence, 2 primary signals: rejection of the 200-day moving average and rejection of the high of the order block. That's it. So I entered here I position sized. I entered at 305.20. I placed my emergency stop as always 2 ATRs below. My end of bar stop is simply a close below the 200-day moving average, the black line. I place my trailing stop level 1.5 ATRs above. Next day goes up. Next day goes up. Profit target. Next day goes up very nicely, multiple profit targets, also got to trailing stop level. And then we've kind of moved sideways here. I did hit one profit target on the 29th when we went from the close into the high up pretty substantially. And so this particular trade, doing pretty good, up 3.13%. I am in trailing stop mode, so if in the future I get a close below previous bar's low, I'll have to get out of the trade. We're at a 59.50 RSI, so if I get into the 65 RSI levels, then the 5 EMA will come into play. If it gets to 65 RSI and then closes below the 5 EMA, I will be completely out. We do have earnings coming up on the 9th of February. I never hold through earnings, so regardless of, as long as I'm in this trade, right into earnings, regardless if I'm up, down, sideways, doesn't matter, I will exit the entire trade prior to earnings. I never hold through earnings. But anyway, nice little example of two primary signals, rejection of a deep dip by 200-day moving average and rejection of the high of the order block. Remember, it's key level within key level. That's what I'm always looking for. I'm looking for a key level within a key level. The key level, the first key level was the 200 with that lived inside the key level of the order block, and the price showed that it rejected both the 200-day moving average and the high of the order block, which is bullish, and it did play out. So up, remaining shares on McDonald's up 3.13%. Okay, Berkshire Hathaway. Really good setup, everybody. It's working out fine so far. Doesn't mean it's going to in the future, but it's a very interesting. This is a very interesting setup, and I'll explain why. So I did enter Berkshire, BRKB, on the 29th of January at 475.68. Why? Well, first thing, we rejected the bottom of the order block. Now with order blocks, you can have a rejection of the high of the order block, you can have a rejection of the low of the order block, you can have a rejection of a moving average or another key level inside the order block, okay? But we rejected the order block. We also, well, the previous day we were under a 30 RSI. And then the next day we closed above. Here, I'll go back and I'll show you. So if we go back to the day before I bought it, look at the RSI, 29.22. It actually rejected the order block on that day, but it didn't close back above 30. So that's why I passed on the trade on that day. But the next day, look, we closed back above the 30. We closed at 33.75. So we have a rejection of the order bottom of the order block. We close back above the 30 RSI. Key level within key level, two primary signals. Now I just talked about the megaphone trend line. This came into play as well. Swing low over here, another lower swing low. We connect those. We run that trend line, that megaphone trend line out into the future. If and when you get to that trend line, generally, if you have a reaction, you will have a bounce from there. And did we have a reaction? Yeah, we certainly did. On the day that I bought it, we closed back above that trend line. See, the day before was still under. So you need a reaction, a close back over to reject the trend line. And so that's exactly what happened. So now, how many signals do we have? Rejection of the bottom of the order block, rejection of the 30 RSI, and a rejection of the long-term trend line. So far, 3. I have 2 more for you. We also formed a V2 on this day, a V2. And listen, if you want to learn more about V1s, V2s, you can go to my YouTube channel. I have a really good video there that explains these in detail. V1s and V2s are great. They're entry signals. They help me in any trading strategy that I'm using. If it has a V1 or V2, it automatically gets extra bonus points. So I have V1s and V2s. This is a V2. So let me explain a V2. A V2 consists of 3 bars. Bar 1, bar 2, bar 3. Bar 2 first has to go below bar 1. Do we agree that bar 2 went below bar 1? It did, for sure. Next rule is that bar 3 has to close above bar 1's close. Did it do that? It did. 1, 2, 3. Bar 2 goes below bar 1's low. bar 3 closes above bar 1's close. That, my friends, is a V2, okay? So now we have 4 signals, but yet we have one more. Remember when I was telling you about the negative third ATR channel and how 92% of prices stop going down and go up if it rejects? Well, look, the day before it closed under the negative third ATR channel. On the day that I entered, it closed above. So we have 5 particular signals on this trade. That's fantastic. It's hard to get 5. Does it guarantee that Berkshire is going to go to the moon? Absolutely not. I wish, but no. But does it put the odds in my favor on the trade? Yeah, it helps the odds. It increases the odds of having a profitable trade. And so there you go. That is why I took the trade on Thursday at 475.68. So as always, I position size. I place my emergency stop 2 ATRs below. As always, where's my end of bar stop? My end of bar stop, two different ways I could go here. A close below the order block or a close below the trend line. Just to make it easy, I'll just say a close below the order block because it's such a well-defined line right there. I think 472.96. Oh shoot, I forgot to place my trailing stop level above. Well, here, let's do that. You have to go to the day that I entered the trade. Oh shoot. Okay, so we look at the 1.58, the 1.5 reading is 938. So I take my entry price plus 938, which is about right there. So make that my orange line. Okay, perfect. So there you are. That orange line is my trailing stop level, 1.5 ATRs above. Now, so I took the trade on the 29th at 475.68. Obviously, it was up on Friday, up 0.88%, and I did hit one profit target. You can see the profit target was 286, and it went up 417. So yes, I hit one profit target. I took 10% of the shares that I had. If I had 1,000 shares going into this day, I would have taken off 100, right? Lighten up a little bit has the effect of tightening up the stop. So I'm not in trailing stop mode yet. If I do, then if I have a close below previous bar's low, I'll get out of half. But it's a good start to a really good setup. Again, I don't know if it's going to hold. You never know. But it is up from where I entered it 1.03% a day. So it's not too bad. But this is a perfect example of multiple signals happening at the same time, which improve my chances. And we'll see what happens. But I like the trade up 1.03%. All right, VIX. Well, this was quite a trade. This was quite a trade on VIX, and I entered on the 15th of January at 26.29. Let's review why. Okay, order block. We have a swing low. After swing low, we need a swing high, right? Swing low, swing high. Then we need another swing low that's lower than the first swing low. Do we have that? We do. Swing low, swing high, lower swing low. And remember, after you have that pattern, swing low, swing high, lower swing low, you need to look to the first swing high. If in the future you take it out, which we did here, now we've changed market structure to the upside, okay? Once you change market structure to the upside, I am waiting for a pullback into the order block. So when you change market structure to the upside, you know the old saying, buy dips in an uptrend? This is exactly this. The order block and the changing of the market structure tell me that we have moved into a bullish structure. So therefore, I want to buy dips, and I wait to buy dips in the smart money area. And that's exactly what I did here. I bought at 26.29. I placed my emergency stop, of course, 2 ATRs below. My end of bar stop, simply closed below the low of the order block. And look what happened. The next day we went up a little bit, and then we had a blast off move. It went up 15%. I hit so many profit targets. I think this was my maximum that I've ever hit. I think I hit 8 profit targets on this day into that strength. And then look what happened. The next day, did we close below the previous bar's low after reaching trailing stop level? We sure did. And I locked in half. I sold half for a gain of 1.76%. Okay, fine, great. But a majority of these shares I sold into that dramatic blast off. And then look what happened. We came back into the order block. We came back into the smart money area. And again, that's where it bounced. And then here on Thursday, I hit multiple profit targets again on this big move up before it came back. So I honestly, I don't have a lot of shares left here. I'm just keeping this trade just for an example to show here on the podcast. But look, swing low, swing high, lower swing low, market structure change, check back into the smart money area. Did it work? It certainly did. Took off again, went through my process, sold half here, got back to the smart money again, and then took off again. So one thing big picture is if we do head back into this bullish order block, it's a good chance it could bounce here again. And what does that mean? That means that the market would go down, right? So I every time we have an new order block on VIX, I always try to talk about this on the podcast, and a lot more times I've been right than wrong. When you change market structure to the upside on VIX and then it comes back in, be careful of the market. And you can see, yeah, it was right. So the remaining shares, which are not a lot, but the remaining shares on VIX up 4.51%. Okay, Apple. All right. I took Apple on Friday. And usually I'm talking about moving averages. Usually I'm talking about order blocks. But this is what is called a higher low V1. And I'm so glad this happened because these haven't happened a lot lately. But I really like this trade. I use this trade. I teach this trade. But let's start off by taking a look at these two green lines. This is the -1 ATR channel. This is the +1 ATR channel. Anywhere inside these two lines is considered the value zone. So this is called a higher low V1. So let me tell you the rules first. The first rule for a higher low V1 is that we need to close below this lower green line. And clearly we close below, right? But then, so first close below. Well, even this bar's closed below, so that qualifies. Close below the bottom of the order block. The second requirement is you need to go back in and close in the order block. Did we do that? We sure did. Then the third requirement is that you need to have a pullback. And then the fourth requirement is you need to have a V1. A V1, I told you a little bit earlier about V2s, but a V1 consists of two bars, bar 1 and bar 2. Bar 2 has to go below bar 1's low. Would you agree that bar 2 went below bar 1's low? Yeah, it did. And then bar 2 has to close above bar 1's close. So it qualifies. Two bars, bar 1, bar 2. Bar 2 goes below bar 1's low, washes it out. That's why we call it the washout bar. And then proceeds to close above bar 1's close. That is a legitimate V1. And this is called a higher low V1 in the value zone. The reason it's called a higher low is this low here is higher than this low here in the value zone. So close below the value zone, goes into the value zone, pulls back, creates a V1 that closes in the value zone. And the key is the bottom of that V1 has to be higher than the previous swing low. Higher low V1. So I entered on Friday at 259.20. I position size as usual. I placed my emergency stop as usual 2 ATRs below. Now on this particular trade, my end of bar stop on a V1 or a V2 is simply a close below halfway of the washout bar. The day that I bought it is the washout bar because it closed below bar 1. Halfway of that bar from a Fibonacci standpoint is an important support level right here at 256.60, right? I bought 259.20. So just to make it simple, going forward, if Monday it closes below halfway of this bar, I'm simply out. I'm pretty close to that level anyway, so my risk to reward is good. Of course, I have my safety net down here in case it all hits the fan, right? And then up here, the orange line is what? It is my trailing stop level. If it gets up there, then I go into trailing stop mode. In addition to all of this, look, we have the order block, right? We also rejected the high of the order block. So we have a lot of things going on. We have a legitimate higher low V1, totally legit. But in addition, we rejected the top of the order block. So that adds some bonus points to the trade. So again, I entered 259.20, emergency stop 2 ATRs below, end of bar stop is closed below halfway of the washout bar, 256.60. So Monday or anytime next week, if it closes below that, even by a penny, I am out. So I'm essentially completely break even on the trade since I just bought it. So there you go, everybody. Those are the current open positions. They're all doing quite well. Very, very happy and feel very fortunate that I had a really good week with that. So now let's get on to the trades that I closed out last week. Some positive, some negative, but remember what I say, when I'm wrong, I try to get get out immediately. All these trades that I showed you, these positive trades here, I've been in those for a while, right? Many days to weeks. And the reason I've been in them is they've been working. The ones that don't work, boom, I'm out. That's it. So let's start with these are the 1, 2, 3, 4, 5, 6 trades that I closed out last week, and let's talk about why I exited them. Okay, so this is UNH. Now, I wasn't in this trade very long. I was in this trade for 4 days, and I exited because of earnings. I don't hold to earnings. And you can see that was probably a pretty good idea that I exited before earnings. But I entered the trade here on the 20th of January at 388.20. Why? Well, you can see we have a green box. That means we have an order block from the past. On the day that I entered, it did two things. It rejected the high of the order block and it rejected the 200-day moving average. Okay, two primary signals. Now, generally, I'm not going to take a trade this far up, but I use the 200-day as my stop. Look, I closed above it. I have the support of the 200 above below me. In the future, if it had closed below, I simply would have got out. But I'll get a little bit more into that in just a minute. But the reason for the trade were threefold. One, we rejected the high of the order block. Two, we rejected the 200-day moving average. The risk to reward to the 200-day moving average was really good. Okay, so I entered, I placed my emergency stop below. My end of bar stop was a close below the 200-day moving average, good risk to reward ratio. But the third reason I took the trade was here on these elder impulse bars. You see, the previous day was red. The very next day was green. In all my years of trading, I have discovered when you go red to green on the bars, you go very bearish to bullish in one bar, that's giving you a little hint that higher prices are more likely than not to come. Now, I didn't take the trade just because it was red to green, but I took the trade in conjunction because we rejected the high of the order block, we rejected the 200-day moving average, two primary signals, and cherry on top of the trade was the red to the green. You remember on bullish abandoned babies, I said if you have a very sudden change in sentiment from bearish to bullish, well, yes, the gap downs followed by the gap ups indicate that. But also on the elder impulse, and you can get this on most trading platforms. But when you have a red to green, that's kind of showing you the exact same thing, a very sudden change in shift of sentiment from bearish to bullish. So that's why I took the trade, okay? Rejection of the high of the order block, rejection of the 200-day moving average. The 200-day moving average was very close, so good risk to reward ratio, and the red to green on the elder impulse. So I entered 388.20, emergency stop 2 ATRs below, and the bar stop closed below the 200-day moving average. I placed my trailing stop level above 1.5 ATRs above. Next day took right off. Great, good start to the trade. Took off some profits into that. Next day up again, sold some partial profits into that strength. Next day went up a little bit, but not enough for a profit target. And then here I exited. Any particular reason? Well, not really. I mean, yes, actually it closed below the previous bar's low, but on this day, this was prior to earnings. So I just exited the entire trade. Now, this is a very good example of why I don't hold through earnings. Had I held through earnings, look what would have happened. So really, I never hold to earnings. So it was a good trade. It was a nice little trade, up 3.85%, locked it in, done, avoided the carnage to the downside through earnings. So that is why I exited that trade. Shopify did not work this week, right? And not all trades are going to work. It was a really good setup. I entered the setup here on the 23rd of January at 137.80. Why? Rejection of the 200-day moving average, deep dip buy moving average inside the order block. Perfect trade. 200-day moving average was my stop. Next day went down, but held the 200, kept me in the trade. Next day went up. Not enough for a profit target. Next day went up. Thankfully, I took off some profits into this strength at a profitable level, right? Next day went up again. I took off another, I hit some more profit targets into that strength, thankfully, because look what happened on Friday, right? How much did I lose? Well, I lost. Look, my stop was a close. My end of day stop was a close below the 200, and it certainly closed below that. I lost 5.01%. But you see the value in taking the partial profits when you have them, because it did mitigate the loss on Friday a little bit, right? I took off about 20% of the trade. So taking those partial profits did limit the loss by 20%. That's pretty substantial. But again, it was a perfect setup. It didn't work, and I had to get out. In the remaining shares, I had a loss of 5.01%, which is not fun, but does it mean I lost 5%? No, right? I position sized correctly. So if it got to my emergency stop, how much would I have lost? 1%. So, this was like 0.6%, but still not a great trade. I mean, it didn't work out. It was a good initial trade, and that's all I have control over, of getting into a good initial trade. And it started to work out well, but Friday just didn't work. So had to lock in a loss of 5.01%. Netflix. Netflix. I've tried Netflix multiple times. Nothing has worked. But look, I got in here on the 27th of January at 85.60. Why? Really good confluence signals. Two perfect signals, actually. We rejected the bottom of the order block, and we rejected the 30 RSI. Perfect. Got in at 85.60. Position size, place my emergency stop 2 ATRs below, place my trailing stop level 1.5 above, and next day, boom, close right below the 30 RSI and close below the order block. What did I have to do? I had to get out. Did I take a loss? I certainly did. I took a loss of 1.1%. Not too bad, just fine. But the key takeaway here, again, is if I have profitable trades, I'm going to be in those trades days or weeks because they're working for me. Many of my trades are my losing trades are exactly this. I get in, next day out. If they're not working, boom, wash my hands, done. I can always get in in the future if I have another legit signal. Most traders do the opposite. They hold on to losing trades for a long time, and when they have winning trades, they take their winners too quickly, right? We need to do the opposite. We need to be very impatient with the losers, and we need to be very patient with the winners. And here I was about as impatient as possible. Got in, next day, didn't work, out, boom. And it was the right move so far. So I lost 1.1% on that particular trade on Netflix. AMD, really nice trade. I got into AMD here on the 12th of January at $207.77. Why? Well, you can see the green box. We had an order block, and we have a moving average, this time the 100-day moving average. Inside the order block on the day that I took it, we rejected both the top of the order block and we rejected the 100-day moving average. I got in 207.77. I position size. I placed my emergency stop 2 ATRs below. My end of bar stop on this trade was simply a close below the red line. Look how close I was to it on the day that I entered. If the next day it had closed below by a penny, just out, right? So I entered 207.77. I also placed my 1.5 ATR trailing stop level above. Next day takes off like a rocket ship. Fantastic. Great start to the trade. Hit some profit targets. Next day up a little, but not enough for a profit target. Next day up very nice, multiple profit targets. Next day kind of a nothing, up a little, but kind of a nothing burger. Next day up a little. I did hit one profit target. Next day up very nice, hit multiple profit targets. Next day up, and then here on this particular day, which was the 23rd, again hit profit targets. Now, on this particular day, we closed above 70 RSI. Remember, as soon as it gets to 70 RSI and then it closes below 70 RSI, I'm going to take half. But in this case, the next day it did close back below the 70, but it also closed below a previous bar's low. And when those two things happen together, I exit the trade. And so I did exit the trade here at 251 even on 126.26. And I mean, it was a fantastic trade. Fantastic trade, up 16.96%. Never did this trade disappoint. It went straight up. And again, why? I was patient. I waited for a rejection of a key level within a key level, a rejection of the 100-day moving average inside the order block, or in other words, the smart money area that it pulled back to, right? Now, am I glad I got out here? Were my signals right? They were, right? I mean, we're lower than that there. So anyway, good example of a really nice trade and a nice example of a rejection of a 70 RSI to get me out of the trade. So this particular trade, really nice, up 16.96%. RBLX. Well, I talk about hitting the emergency stop only about 5% of the time. Yeah, I hit one. I'll tell you, in the last 2 weeks, I have hit 1, 2, 3. 3 in the last 2 weeks. And if you watch this channel regularly, you don't see me hit them very often, but the last 2 weeks have been very volatile. And I got hammered on this trade for sure. I got into RBLX on the 26th at 73.40. Why? Really nice confluence of signals. Rejection of the bottom of the order block and rejection of this long-term megaphone trend line. Got in 73.46. Placed my emergency stop 2 ATRs below. My trailing stop below, I must have deleted it. On this particular, here on the 27th, we closed above that trend line. That kept me in the trade, unfortunately. Then the next day up, at least I hit one profit target, right? Mitigated the loss a little bit. And then Friday, boom, look, hit my emergency stop. What happens? I need to get out immediately. And I lost 1% of my account by doing that. Percentage-wise, not good. It was 10.09%. Did I lose 10% of my account? No, I did not. I lost 1%, right? Because I position size. But again, putting a plug in for taking partial profits. Am I glad I at least took 10% off when it was positive? Yeah, sure, because it reduced the overall loss by 10%, which better than nothing, right? But yeah, hit the emergency stop. That's why they're there, and that happened. So that was a loss percentage-wise, or yeah, percentage-wise of the trade of 10.09%. So emergency stops happen. That's why I have that safety net there. And then last but not least, on the dailies, Meta. I did enter Meta here on the 21st of January. Rejection of the high of the order block. Rejection of a long-term trend line below us. Rejection of the negative third ATR channel. I got in at 612.69. I placed my emergency stop 2 ATRs below. My end of bar stop on this particular trade was a close below this trend line. Placed my trailing stop level 1.5 ATRs above. And next day, boom, took off like a rocket ship right off of that entry signal. Hit multiple profit targets, got into trailing stop mode, Next day up a little bit. I think I hit a profit target here. Then 3 days, kind of nothing. I had to get out here. Why? Because of earnings. Now, this is one I wish I would have held through earnings, but I never hold through because this one rocketed up. But still, this was a really, really nice trade. It went my way immediately and locked in a gain of 8.36%. So there you go. Those are all of the trades that I did exit, the daily trades that I did exit. I have one more for you that I'm going to show you. This is the dollar. This is on the weekly bars. I like to trade both on the daily time frames and the weekly time frames. And so let me quickly take you back. I've been in this trade a long time. I entered back here on the 7/11, the 11th of July at 26.31. Why? Two primary signals. Here we have a previous order block. On the week that I entered it, it closed above the order block. That is one legitimate entry. In addition to that, the previous week closed under the 200-week moving average and then closed back above it. So there's your confluence. Close under, close over the 200-day moving or 200-week moving average. That is a deep dip buy signal, and we rejected the top of the order block, which is an order block signal. So I entered at 26.31. I position size. I placed my emergency stop 2 ATRs below. My end of bar stop, simply a close below this 200-week moving average. I placed my trailing stop level 1.5 ATRs above. Next week, took off, profit target, great start. Next week, came back down, retested the 200, but closed above, kept me in the trade. Next week, big week up, multiple profit targets, sold into that strength, got to trailing stop level. Next week down, next week down. First close below a previous bar's low after reaching trailing stop level. What do? I took off half of the position there, locked in a gain of 0.49%. Then we moved sideways for about 5 weeks. This week was interesting because during the week we were below the 200, which was my end of bar stop, but we closed above, keeping me in the trade. So kept the trade. Next week up, profit target. Next week down, nothing. Next week up, profit target. Fantastic. Couple weeks sideways. Next week up, sold a profit target into that strength. We never quite got to the 65 RSI level, so the 5 EMA never came into play. And then we basically went down for a month and a half. Then we did move up here where I took a profit target and then down, down, down. This saved me from getting out of the trade. Remember, I'm using the 200-week moving average as my trailing stop at this point, and during the week it was significantly under, but then it closed above. It kept me in the trade. So I have to keep talking about this trade that I've been in for 100 years. But anyway, it's fine. It's good to show the process of how, every week, what I need to do, and the remaining shares up 2.01%. So there you go, everybody. That was a lot of trades, the open trades and the trades that I closed. But I hope that was helpful for you to see how I deal with winning trades, losing trades, how I manage them. And if it was, I would appreciate it if you could hit the thumbs up button. It does help with YouTube a lot, lets YouTube know there's some valuable content here. So before we get to the potential trades for next week, let's spend a few minutes and talk a little bit about trader psychology, because really it's the most important skill in trading. So let's check this out. Okay, this week's trader psychology comes from my good friend Steve Byrne. I'm sure a lot of you know Steve Byrne's great trader, great author. Check out all his books, his trading books on Amazon. Wonderful books. Moving Averages 101, one of my favorite books, and I was lucky enough to write the foreword in that book for Steve. So please follow Steve at S. Joseph Burns. He has great content every day. But let's see what Steve has to say here. There is nothing to fear with the single trade when you position size right. It's really true. As a matter of fact, I was just teaching one of my new students, Nacho. Hey, Nacho, if you're listening, hope we had a really good first lesson. But I was trying to make this point to Nacho last week during our first lesson about position sizing. I know what my maximum allowed loss is going to be because of my emergency stop, right? But if I say my maximum allowed loss is 1,000, but I don't really mean it, then I have something to fear. So as traders, my suggestion when you're setting your stops, really think about, are you okay with that particular loss? A lot of people say, oh yeah, I'm good with 5,000. Are you? Really? Like if it happens, you're going to feel great about that. And what about if you have two that happen the same day? What about if you have three that happen the same day? So I always suggest to other traders and my students, go lower than your initial thought. If you really think, hey man, I'm cool with $1,000 loss, go to 500. Because if you're cool with 500, with 1,000, you really should be cool with 500. And in my experience, most people, the initial stop loss, they say they're not really okay with it. But if you are okay with it, then the worst thing that can happen, there's really nothing to fear. Like Steve says, there's nothing to fear. If you are really okay with a $500 stop loss, the worst that can happen is you have a $500 stop loss, right? And so you don't really have to sweat it. So the most important part of trading, regardless of what strategies you trade, how you trade, is your position size. It is the most important thing. And you really have to go sit in a quiet room, sit on a chair or on the floor and think to yourself, okay, I have to be really honest with myself. What maximum allowed loss on each trade do I truly think I'm okay with? And use that number. And like I said, it's usually lower than the first thing that's going to come to your head. But then if you have that perfect number, yeah, trading is easy. Worst case scenario, that happens. More times than not, you're going to make money. So think to yourself, what is your maximum allowed loss? Truthfully, what is it that you are really okay with, right? So anyway, I hope this helps everybody, but position sizing is the most important part of trading. And I would always suggest having a smaller number than a larger number, especially at the beginning. So thank you, Steve Burns. Appreciate that. And now let's get over to the potential trades for next week. I think I've got some good ones, and I've got 11 of them. So let's start with ARK, ARKK. Now I always mention this, everybody. Here I have 11 symbols. It's possible that all 11 of these could trigger sometime next week on the same day. But that doesn't mean I'm going to take all 11. I only take one trade per day. Even if I have 11 that are legit, I'm still going to have to narrow it down to the best one. And how do I do that? Well, I give a report card, I give a scorecard to each particular legitimate trade. If it has one signal, I give it 1 point. If it has two signals, I give it 2 points. 3 points. Normally, the one that is 3, I would take over 1 or 2. But sometimes you have to reverse engineer the risk to reward ratio. I've seen signals that have 5 signals, but have a horrible risk to reward ratio. Well, I may have to pass on that because the risk to reward ratio is not very good. Okay. So, the devil's in the details when it comes to trading, but I like to score my trades to help me pick when I have multiple candidates. I also look at higher time frames. Like if I'm trading the daily, I want to look to the weekly, see if that's giving me any information, potentially other signals on the higher time frame. I like to look at the relative strength of the market. Maybe the market's down, but this particular stock is up. Okay, gets an extra point because of its relative strength. But this is what I use. This is what I teach to my students. And I think it's very important. And by the way, I do teach a 20-hour one-on-one course. I've taught students from all over the world. I love to teach. I've taught for many, many years. And I think the best way to learn anything is one-on-one. You can ask as many questions. And the course that I have, 20 hours, we do it 2 hours a week for 10 weeks, there's a lot of advantages to doing that. One, you do it once a week so you don't get too much. Two, when you do it over 10 weeks, you're seeing changes in the markets over those 10 weeks, which I think is really important. But I have taught students from absolute beginners all the way up to the hedge fund level and everywhere in between. So, all of the trading strategies that I use, I mean, I really use them. That's how I make a living. and I will teach them to you step by step, each rule by each rule, for 20 hours. And when you're done with that course, I promise you're going to be a better trader. I promise you are going to be a better trader. You're going to have a lot of tools in your tool belt to use different strategies for different markets. And it's very important to me when I'm done with one of my students that I know they know everything I've taught them and that they have the skill that they can use the rest of your life. So if you're interested, please send me an email. The email's in the link of this YouTube video. And when I get emails from prospective students, I say, hey, thanks for saying hello, appreciate it. If you're interested, let's have a video call. It's a free call. It's not a sales call. I promise you that. It's just a call for me to learn a little bit more about you, your trading challenges, your trading goals. And it's also a really good opportunity for you to ask me questions about the format of the course. And like I said, it's not a sales call. I just, want to put a face to a name and see if we're a good fit. So if that's of interest, I'd love to hear from you. Just send me an email. Now, you've heard me talk about you've heard me talk about deep dip buys through the podcast today. If you like online courses, I have a really good online course where I teach you step by step how to trade the deep dip buy stock trading strategy. It's 9.5 hours. It's a really great course. It's very affordable. It's somewhere between $30 and $50 at udemy.com, and the links in the description there. And that's a good place to start. So either the 20-hour one-on-one or the Udemy course is a really good place to start. But I'd love to have you as a student, so I really would love to hear from you. So, okay, let's start with ARK. ARK is really good. As a matter of fact, one of my students, Vivek, up in Canada, pointed this out to me on Friday, so I included it here because it is a really good setup. And look, we have an order block, big wide order block here. Swing low, swing high, lower swing low, market structure change, defines the order block. And what do we have living inside the order block? 200-day moving average. It's exactly what I want. I have my line in the sand. I have a major level, which is the 200 inside a key level of the order block. So next week, if we reject this 200-day moving average, which means we either bounce at the 200, we close under, then close back over, or we go down through it intraday and then close back above it, all three of those are rejections. If we reject the 200-day moving average, I certainly would consider taking the trade because it's a key level with which is the 200 by itself, key level deep dip buy within a key level. And it gives me a very good line in sand, helps me structure the trade to where I have potential big upside with potential limited downside. So I'm looking for a rejection of the 200-day moving average, which at the moment is 73.85. Okay, let's go to the Dow Jones, DIA. All right, well, we have a nice little order block here. Swing low, swing high, lower swing low, market structure change defines the order block, the lowest closing bar, moving it forward. Okay, we're kind of getting within striking distance. Where do you think that I'm looking for this particular trade? I'm looking for a rejection of this 50-day moving average. That's the key level within the key level. The 50-day moving average is at 483.06. You can see on Friday, we were kind of getting close to it, but then it recovered and went up. But that's what I'm looking for, everybody. I'm looking for a rejection of the 50-day moving average inside of this order block. IBB. Okay, IBB, what I am looking for, here we have an order block. Swing low, swing high, lower swing low, market structure change defines the order block. Now, sometimes I have very objective levels inside the order block, like a moving average, like the 30 RSI. Other times I create my own levels within the order block. And the level that I have created in the order block here is 168.50. Why did I pick 168.50? Because on this particular day, on 1/20/26, we had a really big, strong up bar. Now, I teach and I use when you have a really big, strong up bar, generally halfway of that big up bar, you're going to have some inherent support, inherent Fibonacci support, 50% Fibonacci. Well, this was a big up bar. I marked halfway of that bar, brought it into the future, key level within key level. If we retrace back to this halfway, if we retrace back to this big up bar halfway, it is inherent support. And that inherent support happens inside the inherent support of the bullish order block, right? Or the smart money area. So that's what I'm looking for next week on IBB. I don't know if it's going to get there. If it doesn't, that's fine. I'll just go into another trade. But I am looking for a rejection of 168.50 on IBB next week inside this order block. Russell 2000. All right. All right. Here's our order block. Why? Swing low, swing high, lower swing low. Market structure change. Look, when we were up here and you look back at the order block, could you make the case when it was up here that the people buying down here was smart money? Yeah, obviously. Straight up, so clearly, right? So if we get back to this previous smart money area, doesn't mean it's going to be smart money area again. No, it doesn't, but it's more likely to be. And I have this nice little 100-day moving average to help me structure the trade. Now, we're quite a long ways above that. So I don't know if we're going to get there, but I saw the trade and went, ooh, boy, that would be really great if it got there. It's not there yet, but for some reason, next week, if it does get there, I will consider taking the trade. So again, I am looking for a rejection next week of the 100-day moving average inside that previous order block. The 100-day moving average right now is at 248.14. It will change every day, but right now that's where it is, and that's what I'm looking for. Palantir. All right. So Palantir has this big order block back here from the 1121. We actually closed underneath it on Friday, and we closed underneath that megaphone trend line as well. We did reject the 250-day moving average, which is a deep dip buy. But look, we have earnings on the 2nd. So I'm not going to get involved with Palantir at this point. So earnings, I think it's fair to say that after earnings, we're going to go up or we're going to go down. Would you agree with that? So I can look at two different levels on Palantir. If we have good earnings and we close back into this order block and close back over that long-term trend line, okay, possible that I could take that trade. However, we have another lower order block below us from a previous order block. And look what's happening inside this lower order block. We have the 300-day moving average. I love those trades, right? Major moving average within an order block. After we have earnings, it can go up or it could go down. If it goes down and rejects that 300-day moving average inside this lower order block, I would certainly consider buying that. If it goes up, and then it closes above the low of this current order block, and it looks like that low is about 147.24. If it closes back in that order block, then I could buy it there. So it's kind of nice. We have earnings coming up. We know prices are going to move one way or the other. I highly doubt they're just going to stay the same, but they're either going to go up, down, and if they do go down, there's a level that I can key off of to the downside, which is the 300-day moving average in that lower order block. Or if it goes up and closes above the order block, let me get you the exact number on this order block. 147.56. So if it closes back above 147.56, but not nice, gentle close, it can't be up here, it would negate the whole trade. So if it closed back, it had a nice, gentle close back above 147.56, that would be a potential. Or if it goes down, a rejection of the 300-day moving average in the lower order block is what I'd key off of. So this is kind of interesting in trading, right? I have levels above me to get in. I have levels below me to get in. Let's go to the Qs. All right. Well, Qs have this big, wide order block here, right? So I need to have a level inside the order block to improve my risk to reward ratio. Well, you can see previously when we rejected the 100-day moving average inside the order block, it held as support. Well, if the Qs continue down, I am also going to key off of that 100 again. So if it comes down, rejects that 100-day moving average and gives me a good risk to reward ratio, I could consider getting in there. My stop would simply be a close back below the 100. So I have a good risk to reward ratio. I have a line in the sand that I'm keying everything off of. So that's what I'll be looking for next week would be a continued move down in the Qs with a rejection of the 100. Right now, the rejection, the 100 is 612.08. TMC, the metals group, I've traded this multiple times and had really good success with it. Of course, the metals group, TMC, has come down significantly because of the move down in silver and gold, and the mining stocks last week, I mean, dramatically on Friday. But we do have a nice little order block here on the 31st of January. The high and the low of that order block I have brought into the future. And look what's living inside the order block. Right at the bottom, there's the 100, right at the bottom there is the 200-day moving average. So next week, if we go down, reject that 200-day moving average, which is at $6.02, I would certainly consider taking that trade if the risk to reward ratio is good, right? United Airlines, UAL, okay, well, United Airlines come down significantly, and we have a nice order block that started back here on the 17th of November. Look at all the major moving averages that are living inside the order block. All of the deep dip buy moving averages are there. The 200, the 300, and the 250. Great, great. So potentially, if United Airlines continues to go down and rejects one of those moving averages, I can use that moving average as my line in the sand for my end of day stop. And I have three to choose from. The 200 at 93.89, the 250 at 91.95, or the 300 at 93.23. But it's kind of interesting when you get all of these major moving averages kind of nesting in the same spot. That kind of improves the chances that those levels will hold. Maybe, I'm not saying, but more times than not they do. But we are still kind of significantly above there. So I don't even know if they're going to get there. But if they do get there, I will consider it. UNH, all right. Well, I did take UNH, and I was fortunate enough to get out of the trade prior to earnings. But this particular, what I'm looking for on Monday is kind of almost exclusively a Monday kind of situation. We had talked about V2s using 3 bars. Well, right now we have the potential to have a V2 on Monday. Bar 1, bar 2. Bar 2 goes under bar 1's low. If bar 3, if on Monday we close back above bar 1's low, and bar 1's close, which is 292.29. So essentially, I draw a line there on bar 1's close. If we were to close back above there, not only would we have a rejection of the bottom of the order block, but we would have a higher low V2, because if this is the low, that is higher than this low. I would consider getting into that trade, but this is kind of a special trade, right? I need it on Monday to close above 290.30. If it does that, then I will have two things. I will have a higher low V2 and a rejection of the bottom of the order block, right? Which would be a nice legitimate signal with a good risk to reward ratio. So, I use these different strategies, but then I morph them together. And the more I morph them, and the more these setups have all the different strategies, or a large number of strategies happening at the same time, multiple strategies happen at the same time, it just increases the chance of having a legitimate trade. So just to be clear, if it closes above 292.30 on Monday only, we'll have a rejection at the bottom of the order block and a higher low B2, and I would consider taking the trade. XLF. All right, I've been talking about XLF for weeks. It just hasn't got to where I want it to get to, but I know where I want it to get to, and I will share that with you right now. There are 3 levels. There's the 200-day moving average, the black line, which is at 52.45. Now, this did poke its head outside of the order block, but it's pretty close to it. So I still would consider taking a trade with a rejection of the 200-day moving average. The 250, which is the purple line, is very clear. It's in the middle. I would certainly consider that. Or the 300-day moving average, which is also in the order block, I would certainly consider that. So just to make it simple, I'm looking for a rejection of the 200-day moving average at 52.45, or a rejection of the 250, which is at 51.89, or rejection of the 300, which is at 51.52. All right, last but not least, thank goodness, is XLU. XLU has a nice order block. It has a nice 200-day moving average right in the middle. Remember, key level within key level. Look over here. I didn't take this trade on the 23rd, but it was legit. It bounced at the 250-day moving average inside the bullish order block and took right off from there. I didn't take it. I missed the trade. But if it in the future it comes back down again and tests that 200, I also would consider taking the trade, and that's at 42.44. So, man, we went through a lot of information today, everybody. I hope you found it helpful. If you did find it helpful, like I said, I really would appreciate it if you could hit the like button or subscribe. If you have any questions or comments about anything I mentioned here, please put them in the comment section. I'll do my best to reply to your answer or to your question or your comment. I hope you have a really good rest of your weekend. Please be safe next week. If I can help you with your trading in any way, please let me know. Like I said, I have a great online video course at udemy.com, and I teach a really good 20-hour one-on-one course. I would love to have you soon, so just send me an email. So thanks a lot, everybody. I always like to leave off with, please try to go out and do something nice for another person every day if you have the opportunity. It really would just make the world a lot better place if we could all do one nice thing for another human being every day. If you have the opportunity to do one nice thing for an animal, that would be fantastic. They appreciate acts of kindness just like we do. Just think it's good karma and all that kind of stuff, right? So again, if you made it all the way through, really appreciate it. Have a great rest of your weekend, and God willing, I will see you next week, hopefully. All right, take care of yourself. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.